Hello, welcome back to another installment of Mortgage Talk with Nitza and Jess. We are here today. So glad that you are. I am Danitza Nicklow with Berkshire Hathaway, the preferred realty in Pittsburgh. And this is Jess Lyons with Lyonsgate Funding. Hey, Jess.
Hey, hi Danitza. How you doing today?
I am good. How are you?
I'm great.
That's wonderful. So last week we started talking about our process and plans on how to get ready to purchase a home. So, we're going to go from figuring out your budget like we did last week, all the way through to the end, getting the keys and moving in. This week, what is your plan on what we're going to talk about?
Yeah, so this week I wanted to kind of talk to people. So now that you've looked and kind of figured out what you feel like you can afford, now we need to kind of take a look and make sure that that's what the lender thinks you're going to be able to afford as well. Because sometimes people really underestimate what they feel like their payment should be. And then there's other times where people really overestimate what they think they can afford. So what I wanted to kind of show everybody today is how we look at it from an underwriting standpoint and kind of give people the general knowledge to kind of figure out what their ratios as far as their debt versus their income look like. And then that way they'll have a better idea of what we're going to say that they can afford as well. So that's kind of where I wanted to go today and just give them some general knowledge. So when we look at income, the first thing that we're looking at, and a lot of people think that we're going to go by the after tax number. However, the great news is in underwriting, we don't. We go by the before tax number. So we're going to be looking at someone's gross pay, right? So what you get before anything comes out. So let's just say, for example, Danitza, our borrower has a salary of $35,000. So if we're getting $35,000 a year, they're going to be looking at the income from a monthly basis, because when you make your mortgage payment, it's on a monthly basis. So if you look at the screen here, Danitza kind of gave you the calculation of what we're going to do to get your monthly income. So you take the $35,000, you divide it by the 12 months that you have in a year, and that gives you a monthly income of $29,1667. So that is the number that we are going to calculate the ratios from. So from an underwriting standpoint, if you are going to go with a conservative approach, which I think is a good place to start, and then kind of look at the rest of the scenario, because everybody's unique. And on some loans, sometimes we're just looking at one person in the household's income when there might be multiple people. And that could be because the credit of the one person's good, or let's just say, for example, the second person has a job that's commissioned, but they've only been there for 2 years. So there's a lot of different things that really factor into what you can truly afford. But when we're looking at like a general, just real easy scenario, we're going to go by 29% for the housing ratio. So what that means is basically you are going to take the monthly income, which is your $29,1667, and multiply that by 0.29. And that is going to give you your monthly housing payment that at 29% of your income, that's what it would look like. And Danitza, that's $845 and some change. So
now that payment, when you calculate it, that includes, everything inclusive, principal, interest, taxes, insurance, correct?
Correct. That is going to be what you're actually paying to the mortgage company. And some people don't escrow, but you're right. We're going to have taxes, insurance. If there's mortgage insurance, if they're not putting 20% down, the full monthly payment, if it's a condo, the HOA fee, if it's like a townhouse or something, and there's a fee on that monthly, that front end ratio is everything that is being a cost of the house, right? So
the cost of the house payment, not utilities or outside things, stuff that could
right.
change, regularly, but this is once it's signed, the 30-year fixed mortgage rate payments.
Yes, exactly. That's correct. There's only really two types of loans, and the main one that really looks at housing expenses as far as like utilities and things is the VA loan. Sometimes when you get into USDA, they might look a little bit at it, but for the most part, your conventional loans, your FHA loan, they're not going to look at utility cost and any of those things. That it's not factored into the equation really at all.
Okay.
So the 29%, I mean, honestly, I've seen people get approved as high as a 45 or 50% of their housing ratio. But lately it has been a little bit harder to get those higher ratios approved. So for someone to get a higher ratio approved, they've got to have compensating factors. And when I say compensating factors, essentially that means they're going to be looking to see, do they have other monthly debt? What's their total debt to income ratio? They're also going to look at, do they have reserves? So, you know, do you have a 401k that in the case of a hardship, you're able to pull against? And the biggest thing really is credit profile. In order to get those higher ratios approved, they really need to have a very strong credit profile that shows that they have the history of making payments. But every loan product has different guidelines. And as I've kind of spoken before, if you don't know, when we're running the loans through, we put them through an automated system. And depending on who the end loan is, or what type of end loan it's going to be. So for example, with Fannie Mae, we have something, it's called Desktop Underwriter. That's where we run the automated findings through, and it'll come back and it'll say, yes, you're approved, or no, you're not approved. Freddie Mac, it's another conventional loan. They run it through Loan Prospector. And Danitza and I were talking about this a little bit earlier. It's really interesting because the two different investors look at things completely differently sometimes. Like there are times where I'll get an approval for a loan through Fannie Mae, but it won't get approved through Freddie Mac. So it's super important that you work with somebody that's looking at all the different scenarios, because, you know, if you're working with somebody that only maybe does Freddie Mac, then they're going to tell you you're denied and you're not going to be able to get a loan. However, if you're working with somebody that does everything, they might say, hey, you know what, we're going to do it as an FHA, or hey, let's try to look at it as Fannie Mae and see if it gets approved. So super important, more now than ever, just making sure that your credit is good, because it's really going to help you when it comes to figuring out what you qualify. So Danitza, going back and talking about like the total overall ratio. So that's something too that the underwriters are going to look at. They want to see what all of your liabilities are versus your income. And for like a conservative number, I would say 41% of your income. That probably is going to be a conservative number. Once again, depending on the criteria, there's people that have been approved much higher than that, but it is really all on a case-by-case scenario, and it just really depends on if you have assets, if you have good credit. All of those things are going to be factors that the underwriter is going to look at. But let's take a look at how we determine what the total ratio is, so that you guys can kind of understand exactly what we're talking about here. So basically, you're going to take that 29,1667 again, which is what we determined was your monthly income, and you're going to multiply that by 0.41, and that is going to give you the total amount that all of your payments, including your housing payment, can be. So for example, if you are doing, I'm sorry, I have to calculate this out real quick. If you were doing the 29,1667 multiplied by the 0.41, that is going to give you $1195.83. And so the $1195.83 is what all of your payments can come to. And if you already know that your housing payment is going to be that $845, then you can take the difference between the two, and it's going to allow you basically about $350 for all of your other monthly payments. And when I say all of your other monthly payments, just to kind of give you an idea, we're talking about anything that's going to be on credit. So a car loan, a student loan, credit cards, personal loans. They're not talking about your cell phone bill or like your insurance bill. We're not looking at any of that. We're just looking at anything that's coming up on your credit. So it's super important that, you try to keep your liabilities as low as possible, because the lower that overall total housing ratio is, the easier it is going to be for you to qualify. The other thing too, guys, is like whenever you're really serious about getting ready to go and getting pre-approved and buying a house, try not to make any kind of financial decisions. Like, don't be going and buying a new car. Don't really open new credit cards. Anything you can do to avoid opening new accounts will make your life and our lives easier, because when they see these things pop up and when they pull your credit, it'll come up and it'll show anything that's been pulled within the last 120 days. When they see that, they're going to ask you what that is. And if it's been really recent and it's not on the credit, you're going to have to give all kinds of documents to support what it is and like what the payment's going to be for that. So super important. If you can, just really try not to make any kind of changes to your credit once you are getting ready to start the process, and definitely do not open anything while you're in the process. I can't tell you how many people do, but it's horrible. And sometimes it can really cause a problem, because if their debt to income ratio is on the high side to begin with, and then they go and add something in there, it could be the difference between whether or not they qualify. So super important, do not open any kind of accounts while you're in the process, or if you really want to get going, do whatever you need to do, get it done before you're ready to start. I would say probably 60 days prior to wanting to get pre-approved. If you're going to open any new accounts, do it at that point, because it can be kind of problematic.
Now, if somebody has a very tight debt to income ratio in terms of purchasing their house, but they do have a larger cash reserve, that can be used to pay down some of those debts all the way at the closing table. So, that debt to income can work out at the end, even if, on paper at the beginning, it may not, correct?
Yes, that's a very good point. We can do it where people will pay off debt at closing to qualify. And honestly, if we're going to go that route, it is definitely better to have it like you talk to your loan professionals. Certain lenders will allow you to pay it off at closing. Some will say it has to be paid prior to. But honestly, it's much easier to have it paid at closing versus prior to, because if they're paying it prior to, they're going to have to show the source of funds used to pay it, and then they have to show the proof that it was paid. So if you pay it at closing, all you have to do is show that you have the money in your bank account to pay it, and then they're good with that. So everything
that makes life easier,
do,
all for that, right?
exactly. We want to make everybody's life easier. So that's why it's really super important that you're very honest and open, and, talk to your originator, and they will be able to really help you figure out what the best course is on everything to make we want your life to be easy. We don't want it to be a stressful and hard process. It's not fun for us. It's not fun for you. And so that is not our goal. Our goal is to make everything as easy as possible. And when people tell us everything, it makes it so much easier.
Yep. And on that, our usual reiteration, we are here for any questions, any thoughts. We'll work through your scenario one by one with you to make things easier up front. Again, more upfront, the better it is. So I will be honest, I just got a Zoom notice that we are just about out of time today. So again, we did a lot of math and in-depth things, but these are general examples. Let's look at yours in depth. So please reach out to Jess. Her contact information is all below, or reach out to me. My contact information is all below in the comments or description as well. So any questions, we're here all the time. Like she just said, our goal is to make this as stressless for you as possible. So I am Danitza Nicklow with Berkshire Hathaway Home Services, the preferred realty in Pittsburgh. And this is Jess Lyons with Lyonsgate Funding. Have a great day.